it might sound funny. We're not really focused on returns liquidity as such. It may be due to the cause that we've been kind of lucky over the years. But it's more about trying to find those outlier entrepreneurs that are kind of obsessed with, building a successful global category leading company. And it's not easy. So it's also trying to find those and more focusing together with them on the operational growth rather than let's say, the value growth.
The family office became too flexible in the sense that it was trying to cater something to everyone, and then it became very expensive because they can't get to the best deals in every aspect. And then they need a huge team if they need to, which we can't do. So with the expenses going up, not as many people are investing, and the returns are lower. So this started not making sense to have a family office for whole the family. So now the family office are specializing.
Before the summer break, I was on the road in Helsinki, co-hosting the LP Summit at Arctic15. One of the most powerful conversations I had was on how family offices are redefining alternatives at a time of market compression, geopolitical tension, and shifting liquidity timelines. Why tune in? Because this is where the real strategies are being shaped. How investors are rethinking venture, private equity as a whole, and what it takes to balance conviction with flexibility in uncertain times. I was joined by two exceptional voices, a third-generation leader of her Turkish family conglomerate and venture investor, Selale Zaim, and Kim Groop, co-founder of First Fellow Partners, who has quietly backed one unicorn for every 10 startups they've invested in. Now that's a really good ratio. Together, they opened the playbook on portfolio shifts, co-investment models, and how family offices are engineering liquidity in a world where exits are no longer guaranteed, if it ever was. If you want to understand how the next generation of capital allocators are navigating this new reality, this episode is for you.
Alpha's new timeline. The truth is, private market investing has shifted, continues to shift. The market is very different even from when we were here last year. For some of you that were here last year, the topics I think today is really focused on how we're reacting to the geopolitical shifts, right? The tensions that are very, very real, how that's affecting both of you as family offices, principals that are leading in your own right, and thinking about venture as an asset class within that. So let's get started here. Give us a snapshot for those that are not familiar with your work about who you are and how you invest. Let's start with you.
Hello, this is Selale Zaim. I am a board member for our family company. I'm a third-generation family member. In addition to that, I am the head of IC for our venture capital arm, which our holding is a single LP for. But today, I'm here to talk at a different capacity. But our family office is right now inactive. So today, I'm also here as the client of the family office, independent family office, that was born out of our family office. And today, most of my comments will be about the transition from having our own family office to that office becoming independent and us becoming clients of it.
Yeah, great. And just as a snapshot as well, the family wealth was built through?
It's automotive parts for the wheels, batteries. We also have a logistics business, a minibar business, your classical Turkish conglomerates.
Yeah, great. And Kim?
Yeah, so good morning. I'm with First Fellow Partners. It's a private investment firm that we set up roughly 15 years ago with my business partner, Risto Siilasmaa. We primarily focus on direct investments in tech startups, very selectively, as you know, in funds. Historically, we invested in roughly 60 companies. Every 10th company is a unicorn, so we've been very lucky. Or we found a formula to replicate luck, let's put it that way. And as we don't have any external LPs, it's our own money. Initially, my founder's money, but now joint money. It's not a traditional VC playbook, but it's more about founder focus. So we're very have a broad mindset in terms of stage, sector, and how we invest.
And maybe a little bit about your history as well, which helps us sort of frame why you've taken this founder-first mentality with First Fellows. We think that's pretty interesting.
Well, I mean, me personally, I started my business career on the dark side, investment banking. At some point, I saw the light that it's more fun to be working with companies, building companies, and being part of that kind of a, feeling that you can make a change somehow or see an impact when you build something, someone start using your product. It's fun to be part of that kind of ambition and that kind of obsession around founders building something and seeing that they could bring that to market globally.
Yeah. So the elephant in the room, continuing from the first panel that we started here, alpha. Chasing alpha is top of mind, and there is a whole conversation around how we have to recalibrate our expectations given how market shifts have impacted that timeline, the compression in the market cycles. How are you, I mean, in particular, Selale, with your strategy change, which we think is pretty stark compared to what you were talking about last year. Tell us a little bit about this thinking. You know, it's probably drawn from what you're seeing in the market cycles as well.
Yeah, I mean, maybe we picked the wrong funds, but it seems like the returns that we talked about in the prior session are not happening. So for us, even the tenured funds that are on their 5th and 6th are now bringing much less returns than they used to. And when I talk to them, their next fund is not as big as it was always like, oh, we're going to now raise 100 and now 150 and we're going for 250. But now I'm hearing, oh, we don't want to raise such a big fund. And that supports what we talked about in the prior one. And for us also, we're not a massive family office. And for us, we have to pick our bullets very carefully. We can't invest in everything. We can't diversify as much. We can't get into big funds with big amounts anyways. But I do think there is still value in alternatives. By alternatives now, I include VCP and hedge funds as well. I think today's volatility and today's uncertainty gives an edge to hedge funds. It's sort of a magic to some degree, so you can make a bet, but I think the more you diversify, the better it is. And also in terms of VC, I think we need that asset class, although the returns now are resembling more of that of the stock markets. With extra volatility. So there could be an argument saying, is there really value in VC? But I do think there is, because given the challenges we face today in terms of technology, how it will impact human life, how it will impact sustainability, the global sustainability, I think VC holds the key to that. And we will keep investing. We won't be increasing the percentage allocation because we have been doing that for the last years because our entry to the VC class is an 8-year phenomena for our family. Before that, it was all real estate and liquidity assets. So we have been increasing our percentage allocation, but we're going to hold that percentage allocation and keep investing in the same percentage.
So that brings me to what I wanted to ask, which is how are you rethinking your portfolio allocation now in light of the fact that you haven't seen the liquidity that you were hoping for?
So for us, it's different because I talked about our family office splitting. Basically, the family office principal established her own family office, and some of us of the family she had like 16, 18 customers. So some of us became customers of her. Some of them actually had their own team to invest more and be specialized in the asset classes that they're investing. Because it became very expensive to maintain the family office became too flexible in the sense that it was trying to cater something to everyone, and then it became very expensive because they can't get to the best deals in every aspect, and then they need a huge team if they need to, which we can't do. So with the expenses going up, not as many people are investing, and the returns are lower, so this started not making sense to have a family office for whole the family. So now the family office are specializing, and for example, ours is doing more mainstream VC and some liquid investments. They're running their own fund. And for example, before, a couple of years ago, nobody wanted the family office to run their own fund. We also did not want to take that responsibility. But now they're independent, they can do that. And a lot more interest in those sort of hedge funds and sort of funds with different liquidity preferences. And also one of the, for example, families that established its own office is only doing co-investments and VC investments in the sustainability space. So that's what they want to do, and that's what they're specializing, and that's almost solely what they're doing. So we work with them when we want to invest in that section, and they work with other families. So our investment thesis, I guess, changed in the sense that everybody is like doing more of what they believe in, whereas before it was like a medley of investments, kind of an even balance. But now people have different views about the future, so we're investing differently.
Yeah, that makes sense. And I think we're seeing that actually across the globe. And I see Annalika here, so maybe you'll hear from what we're seeing in the UK and across the Middle East. But there's a lot of doubling down on what you believe in and getting a little bit more specialized, because a lot of family offices find, doing everything, jack of all trades, master of none, has not worked. Kim, how do you think this has shaped your portfolio allocation strategy? I mean, what's your reaction to seeing how Selale has reshaped her family office?
I think it's an interesting question. I mean, let me just give from a different angle, different perspective, as we're more focused on doing direct investments in startups. It might sound funny. We're not really focused on returns liquidity as such. It may be due to the cause that we've been kind of lucky over the years. But it's more about trying to find those outlier entrepreneurs that are kind of obsessed with, building a successful global category leading company. And it's not easy. So it's also trying to find those and more focusing together with them on the operational growth rather than let's say the value growth. Obviously, value growth comes as a consequence of operational growth, being successful, capturing market share, etc. When you look at kind of value creation activities around our portfolio, I think it's still about extending the runway, making sure there's enough time. So is it looking at companies that have a business model that allows you to have enough flexibility and enough time to actually tweak and do things that you need to do, because it's really tough to raise additional funding. And then on the theme about value extraction, how to get liquidity or exit, I think it's really hard to even be able to hope for that kind of event. It's about luck and it's about preparation. But I think for us, it's also, we've been more actively looking at these partial secondaries, trying to sell, if a company has reached like a peak valuation, trying to sell 1/10 of our ownership for us to be able to get some liquidity to secure our business doing additional investments.
Yeah. So your portfolio allocation, I know majority is direct holdings into startups.
Yes.
What kind of stages are they? And then when you do opportunistically funds, what makes them qualify to be that outlier in your portfolio?
Well, first on the question about the funds, I think they have been historically more that based in Finland. So if there's a fund or fund manager that has a kind of a waving the Finnish flag, it has been that kind of a, for us, trigger point that, hey, it'd be fun to work with them, as an LP, or perhaps looking at co-investments. So there's no kind of a strong thesis on how we can approach the funds, but roughly I said probably 95% is direct, 5% is LP investments, or it could be smaller. But then on the direct investments, as I said, we don't have a mandate or kind of a playbook. So it has been, many times we're the first investors. I mean, if we find these really strong entrepreneurs, they're planning to fund their third or second company, if we're kind of lucky to be able to partner with them, usually we say that, hey, we could invest 1 million, but please incorporate the company and we believe in you. And then but then we've also been doing these selectively, these kind of late stage, more mature investments. I would define them as like almost private equity. So together with the private equity owner, take control, and it's a different kind of ownership discipline.
You're being a Finn here, you're being humble with your returns in that every 10th founder you invest in is a unicorn. So something about your recipe here has worked. One of the criticisms of family offices doing direct investments is sort of negative selection, right? Like, by the time they come to the family office, it's probably been run of the mill, it's probably not the best deal, and yet you figured it out. For the family offices in the room that are thinking about holding direct investments, how do you make sure you get the best of the pot here?
Well, I think the secret sauce is actually most of those companies have been Finnish companies. Actually, there's been a remarkable shift in the mindset and the quality and the ambition of the Finnish founders. I think in the previous talk there was about Swedish markets and others from the context of the funds, but I think Finnish market has been very mature now in terms of quality and ambition around founders. Yeah, it's not about us picking them. It's being lucky to meet them and hear about them and trying to having an alignment on what they want to achieve and see if we could be the right kind of partner for them long term.
Both of you mentioned a little bit about liquidity and sort of engineering that a little bit to be able to get the returns. And for you, it was very much about going and being a specialist and really doubling down, being good at it before you take a pick. Talk to us a little bit about what that means today.
I think having a family office, maybe it's because of the process that we've been through, is a lot about what's your return and how much you're spending to generate that return. So it is, the more people we have, the more time we spend, the more money we spend on managing this, we can do more things. We can get the best talents, we can do that. But there is a balance for, I think, each family, and that's why it's, I think, the very unique thing. There's a balance for each family in what they think is going to happen and also what they can manage and what they can risk. So for us, we can't, for example, even with our fund on the corporate side, it's a very small fund. We have a team of 2 with some additional freely joining people from the legacy business side as advisors. But it's a very big operational cost for a small fund. So now we're discussing, do we want to make this into a business and make it bigger into a fund? Or do we want to actually abandon the side of the business and actually focus on more strategic investments? So now the competition for talent is high, and talent, I think, is a major cost of running these things in the end. Yes, when you get good returns, it's worth everything, but those good returns take time, and not everybody has the vision or the stomach to do that. To answer your question, the shifts in the market, the uncertainty is making us just kind of, everybody has a differing view, leading to the diversion in investment thesis. And
but are you, I guess the question was, are you also engineering those liquidity outcomes? I'm talking secondaries, you know.
I'm not doing anything because I don't have time, but I wish I could. Yeah, I think about it sometimes that if there was if we could do something that it would allocate portfolio according to what my cash outflow was. But I can barely meet with the family office principal every 6 months. So, but I'm also a very firm believer, no matter what the market is, very, very firm believer, also because it's easier for me to believe that, of buy and hold strategy. I don't make a lot of adjustments at all, also because I don't have time. But I try to invest in a couple of new VCs every year. If a VC that I work with, although they might have stellar returns, if they're good people, I keep investing with them because, you know, the markets change. But if someone is working hard, smart, has a good team, they will eventually get there, is what I believe in. So it's kind of the same thing with your founders.
So founder conviction. How about you, Kim? With the unicorns, I mean, unicorns, it's oftentimes it is also paper valuation. How are you engineering your exits to get the liquidity that you need?
We've been kind of exploring this, selling 1/10 of our ownership in these kind of companies that reach these, let's say, unicorn valuation. We haven't done that frequently, but I think lately we've been looking at that because it's so uncertain. When will there be an exit? What is the structure of the exit? Is it an IPO? Is it lockups? You know, is it cash, etc.? So I think having that, it allows us to have some flexibility as well. But otherwise, we don't put a lot of attention on kind of exit kind of strategy as such. Obviously, I think it's a growth strategy. It could also be exit, you know, exploring mergers, acquisitions. I think I referred to the private equity companies. Yeah. Those that we've been sitting on the board. I mean, one example, that's a local company, but EPAS, we did a lot of these bolt-on acquisitions across Europe. So that's, again, a different kind of a attention focus. But from our perspective as a shareholder, obviously, sitting on the board, you have your fiduciary duty, so you're kind of representing all shareholders, but we wouldn't be kind of seeking for a early exit. On the contrary, we have a handful of examples where the company has gone IPO and we've remained the shareholder for quite many years.
Yeah, and so I guess I wanted to bring it back to Finland as well, Kim. You're a patriot, right? You're investing. You're often also the first check for many of them, telling them to go and start this company. We believe in you, having high conviction. You know, you talked a little bit about the maturity. How do you think the Finland market has grown over the last couple of years, and you know, how is it changing in light of today's volatility?
I think we're only now starting to see the cycle pattern of those kind of companies that were founded, let's say 10 years ago. So those founders or senior people that have had, you know, critical roles or have been critical to those companies, they're leaving and founding their next company. So you see the ripple effects. Also from the perspective that those kind of founders, they have now the means to do angel checks and have skin in the game and be, you know, supporting. So I think we're only now seeing those kind of ripple effects that we really haven't had in this market. And I think that it's building the foundation, the groundwork that many other markets has had. You know, obviously the US over the history and, you know, helping and advising startups. But I think that's one key change that we see. So it's not about us being patriots, it's about all these others being patriots and wanting to help and wanting to support. So you're building this kind of ecosystem. And you see that with the Arctic15, and you see that with Slush as well. So there's a lot of these grassroots activities that kind of build and to support that system.
Yeah. And that brings me to the question of sort of cross-border collaboration among family offices, what you're seeing. I mean, the strong message from Marco Hara earlier was that you all have to get out there, right? You know, get more capital, having more international capital into the Finnish ecosystem is going to be a good thing. What are you seeing on the ground with cross-collaboration, syndicates, that sort of thing?
I think in the face of uncertainty and rising costs, if you find families or family offices that are like-minded, that you can trust, that have similar view on things, it makes complete economical sense to invest together. As I said, we split into 3 or 4 smaller family offices, and when I need to invest, I can get a real estate deal from the family office that specializes in that. So I don't have to hold that resource within myself. Now I can use that. And also we work with family offices that are outside of our family. For example, one of the biggest holdings in Turkey have their own family office, and they're almost professionally providing service only to those families that they agree with. So they don't go out there advertising it, But because we know them and we have a similar view, we do get into their deals, and that provides us an opportunity because they have like fully investment committees and everything for each asset class. So we do invest with them, but I think going forward, this is going to be the best thing. Like, would love to be able to invest in such things in Finland because our network and most of our things are in our region. So the more we can collaborate cross-border with the family offices. And another point is it will be interesting to see how AI shapes family offices. It will definitely shape family offices as it will everything. I can't quite figure it out, but I was just thinking like it would be great if there was some sort of an AI matchmaking tool for family offices that would give you like this family office is a match with your culture, and that would be good, and that would put them together. That would be incredible.
I think an action point for us for next year, we'll have at least one co-investment.
Yeah, that'll be a new goal. But Kim, what are your thoughts here with cross-collaboration, how things are building in a more global scale, even as we're faced with, frankly, a little bit more inward-looking sentiments, right? Everybody's looking inward to their own countries, unfortunately.
Yeah, I could answer that from two perspectives. One is exploring new opportunities, new investments, so deal sourcing, helping each other on due diligence. So yeah, very actively with different kind of. It doesn't need to be family office, private individuals or VC funds for that matter. But yeah, family office especially if they are kind of new breed. Someone has sold a company and just, let's say, set up the family office during the last 10 years. So yeah, a lot of collaboration, I would say. But then also once we're in the cap table, being able to partner and invest in those companies, it's also about the ownership strategy. Who could be the next relevant ones? If we would have an automotive company, given your background with the LP back. So it's, trying to find the right additional parties that could bring the additional credibility to the cap table of those, companies that we have in our portfolio. So I think we put a lot of focus actually on the latter. I mean, who are the ones that could actually be relevant for the next phase? It's not about securing that funding round, but it's who are the ones that, it's recruiting, basically.
Yeah. So as we look ahead here into the future for both of you, what else comes to mind? How else are you, for the family offices that are tuning in, are you repricing your risk in some way? Are you getting out quickly from certain verticals because it's a no-no, you're licking your wounds from certain vintages? What are the lessons learned, and how can we move forward ahead here?
I've been thinking about your questions and my answers, and I think there is one thing that is missing from my answers. So there is significant wealth generation still from our family businesses. And when I say I don't have time to manage the wealth generated from there as much because I'm involved in the family businesses. Not the day-to-day operations, but management of it. And the more we go into the market, the more we see our actual returns from the family companies. And maybe because we're not managing that down, that maybe because we're putting our effort and concentration into these family businesses, it's still generating more than most of our portfolio. Like if you combine all of our portfolio, it's quite a good return. So going forward, I think given the uncertainties, given the unknowns, given the populated things in the market, we talked about how many crazy funds are competing for that 25% in the US, and it's a similar situation in Europe. I think everybody is still looking to the family businesses, and we have the opportunity to make strategic impact there. Because without that, we're just financial investors, and it's a matter of becomes a matter of getting lucky, being at the right place, meeting the right person, having the right allocation available to us. But on the other side, we are actually, you said they come to us. So on the business side, they come to us. But on the financial family office side, we go to them. So I think it's important we have that draw to be able to drive people and investments towards us. And with the strategic value, we can do that more. So I think going forward, with the family offices specializing in their own things, they'll keep doing this, investing in VC, but that's not our main focus. Our main focus will be, I think, going for even more in the family business, the investments we make through them, strategic ones that add on to each other and create bigger value than just financial investment.
Yeah. And Kim, how about you looking ahead? How are you thinking about this whole wave of AI, the shift, the geopolitical tensions? I mean, Finland is strategically located in some ways and not in some ways. How are you thinking about that in terms of your investments?
I wish I had the answer, but I think, as you mentioned, AI, I think looking still the kind of the geopolitical pockets with the data and how that's going to be regulated and everything. So there are so many interesting things that are happening, and how you could use or apply technologies in ways to actually be relevant. So that's one. But then, let me answer that as well from the kind of three dimensions. So yeah, these are the companies. So I think, yeah, the themes are are very interesting around AI and data models. But then again, it's about healthy growth. So I think there are so many companies that are too bullish and trying to, to make too big operational bets. So again, make sure the runway and business as such has a healthy structure, profitable business model. Company doesn't need to be profitable, but the business model needs to be scalable and profitable. In terms of LP investments, we've also been a bit cautious about, I don't want to say bullish funds, but large funds, and then they have the small funds. And some there are GPs that have suddenly 3 or 4 funds. How they manage all those companies, even though they recruit a team. So it's also about what is the likelihood of them being able to actually focus and do the magic that they've done in the past, given the next fund. And then in terms of our new direct investments, I think it's about reasonable pricing and again, the runway and everything. And also with those companies, there's the cap table dilemma. Many VCs have their own challenges or situations and needs, and those need to be reflected as well. So it doesn't always need to be a challenge with the company, it could be with the cap table. So there's so many things happening, I think, right now.
Yeah, I mean, you're closer than many of us to the companies. What are we seeing here in Finland? Are you looking at more picks and shovels for AI, or is it application layers? What are you seeing? What's exciting for you?
Generally speaking, there's a lot of interesting IP heavy. I'm not referring to deep tech in science necessarily. I think there's a lot of companies in that segment. But I think we see a lot of IP heavy interesting companies here. To be honest, even automotive innovations. So quantum computing, dual kind of purpose, defense, etc. So I think there's a very broad kind of a spectrum of interesting companies.
Yeah. Okay. All right. As we wrap up here, I do want to take one question from the audience. But before that, I guess sending wise words of advice to the audience that are principals like you thinking about how to invest.
Well, I think, again, I mean, it's understanding that the investment perspective, I mean, those who haven't been an LP, it's still about a 10-year mandate. So it's, trying to manage the investment at a minimum. And many times longer than that. So having that perspective and reflection and taking that into account.
And before Selale, I see a question there. Yes, Panu.
Well, this is maybe Kim. You said every 10 of your investments turned into unicorn, and I hear constantly very successful VCs saying that the best founders don't need any help, and they're the ones like you can see it, they just go and they raise. So is that your experience though?
No, I think that's a good question. I think it's about the mindset. So, I mean, those that really need help need someone who can manage them and kind of every situation be there for them. I think, yes, then they still need to grow and have that exposure to experience. There's more scar tissue. But I think it's still about the mindset that the best founders, there's a willingness to question their own thinking on some more strategic matters. So an openness to get feedback and perspectives. That's the kind of distinction I see it in.
All right. Take us home, Selale.
Okay, I would say my word for LPs is, I think it's very easy to get lost in the absence of returns and liquidity, and when the things are not performing the way you think they would or they have been. But I think it's very important to keep the long-term view, and I think it's very important to stay closer to the core of value creation. And yes, be open to new things, but not with a panic, with like a measured approach. And when I say staying close to the core of the value, like co-investments like you do, is because you're directly investing in the company. When you become to funds, you lose a little bit of the management, but then you're not managing it yourself, so you're paying that. When you come to fund of funds, it's also good, but when you come to secondaries and all this market, that does start sounding like a bit like 2008 with a different asset class. So I would say keep doing what you know. If you have a good feeling about it, it's probably the right thing.
All right. Well, cautiously optimistic. We're being sent off by Kim and Selale here. Thank you, everyone, for joining us for Rethinking Alternatives with Alpha's New Timeline. Thank you.
Thank you.
Great. Thanks.
And thanks so much for tuning in this week. You can subscribe wherever you get your podcasts and follow our socials on Sarah Chen Global to get the latest on the show. It would really help me out too if you enjoyed this to rate and review our show on Apple Podcasts and share your favorite episodes with a friend. I'm Sarah Chen-Spellings, and you've been listening to $1 Billion Moves.